Hello and welcome to Macro Mondays. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group. This episode of Macro Mondays is brought to you by Onyx Markets, which launches today. Visit onyxmarkets.co.uk to create an account and start trading. For the first time ever, you can trade global oil benchmarks like Dated Brent, Northwest Europe shipping fuel, and US Gulf Coast propane through spread betting and CFDs. Hedge with precision, trade tax efficiently, and gain unparalleled transparency.
And I'm James Todd, direct trader here on the Light Ends desk, looking to give you insight from Onyx's trading floor.
There's plenty to talk about this week. We've had lots of volatility brought around with Trump's inauguration. And we've had a busy weekend with news of DeepSeek out of China, which looks to upend US AI market.
Yeah, on the topic of China, we'll look at PMIs as data looks quite weak out of the East. We'll look at the yen strength as there's been a bit of a panic risk-off attitude there. The Bitcoin environment is entering a period of incredibly high volatility at the moment, so we'll analyze that. And importantly, we'll also be looking at the direct impact of the Trump presidency in its early days and the impact there upon oil markets.
So let's start with the news of DeepSeek OpenAI out of China that's come out over the weekend. This is new AI model, apparently 50 times more efficient than the best US AI models such as ChatGPT by OpenAI. Apparently far more cost effective, built for just $6 million and runs on less advanced chips, not the latest Nvidia GPUs, which of course are banned in China. Now, this is huge news, potentially disrupting the AI supply chain and casting doubt on the need for high-end computing power in the US. What we're seeing overnight, huge moves. The chart here is the Nasdaq. This chart's actually taken an hour ago when the Nasdaq was down 3.5% overnight. It's now down 4.9%. And we're also seeing Nvidia stock, a big move there. Nvidia is trading down nearly 14% pre-market. So if we move on, that slide here, you can see this is Nvidia. This is from Friday's close. We've talked about the double top beforehand, but it's set to open a market way below the support line. Of course, this is a hugely crowded trade. And we had Interactive Brokers coming out on Thursday on CNBC saying today is the highest level of margin we've ever had in our accounts.
Yeah, so I think this is an incredibly noteworthy story, right? The top performers of Nasdaq last year and US equities in general have been all related to AI. That's been the move. Nvidia in particular, it's basically performed so well because it's got, in a market with relatively very high barriers to entry. It's got a monopoly over these chip manufacturing. Now comes along DeepSeek, which is able to be far more efficient and less dependent upon chip processing power, and this fundamentally undercuts and undermines a lot of the significance of the hyper chip manufacturing that Nvidia has been so good at. So I think that's the clear explanation for why Nvidia has been coming off in terms of its equity price. And I don't think this is going to be a short-lived thing. This is going to be an ongoing grapple that they face. And it was already, as you say, a crowded trade. It was the price of shares was far exceeding revenue, etc., because people were forecasting that they would continue to be at the helm of this emerging industry. So first and foremost, you see Nvidia being undermined. Secondly, a lot of the AI companies, as you mentioned, OpenAI, they're going to be coming under heavy scrutiny and being forced to compete more by DeepSeek because, whereas OpenAI haven't open sourced their algorithm and their methodologies, DeepSeek has. It's been, co-developed in MIT. This seems like the real deal. And I think a lot of people in the US, are worrying that the AI industry that Trump, in his Davos speech, had mentioned was going to be, the US was going to be a superpower in AI, and they were going to have to double their energy consumption to power this, flourishing AI industry. Well, it seems as though this might be coming under serious questions now with DeepSeek coming out of left field.
And of course, it questions the whole chip market across the board. And the other important point here is normally when you see markets going rapidly down, the market's been selling off for a few days, even weeks, when stops are triggered. But here it's very different. The news came out over the weekend. The market hasn't even opened yet, and we're seeing valuations down 14% pre-market. So it looks like we're going to see a rout when the market's open. We could even see the Nasdaq being limit down, first time since March 2020. What we're also seeing off the back of that is yields moving aggressively lower. And we are seeing other stocks, Bitcoin's being hit, crypto being hit, Solana's off 10%, SoftBank, bigger investor in tech, is off 8%. So we're seeing this rout across the markets. And what we've also seen last week, of course, with the inauguration of Donald Trump, we're back to the watching the headlines, watching Twitter for Trump's headlines. You may remember in his previous term, during the trade negotiations, which went on for months with China, every Friday night, half an hour before the close of the New York Stock Exchange, he would announce on Twitter that the negotiations are going really well, close to agreements, and equities would rally into the weekend to new all-time highs. So he has the ability to move the markets. He's come out last week calling for 25% tariffs on China and Mexico from February the 1st. He's saying, I'll demand that interest rates drop immediately.
Yeah, I mean, I think it's clear to see that he is maintaining a lot of his rhetoric from his presidential election campaign. However, he did say that on day one there would be tariffs imposed. Now, obviously, this didn't occur, but it seems as though he's still adamant on tariffs, and at the very least using these as weapons up his sleeve in order to leverage results that he wants.
Isn't that pretty good game theory, though? Before he took office, he talked about 60% tariffs on China. The markets got nervous. The day he comes in, he starts to step back from that. So the markets took that
as a bullish signal. Absolutely. Yeah.
Although now you're going to be crippled by this DeepSeek news. You wonder about the timing there as well.
Yeah, I think the DeepSeek news does undermine a lot of what has been really bolstering the US economy going forward. And if you're looking at that, undermining of the tech sector in the US in conjunction with tariffs, which are, fundamentally not pro-growth. Tariffs are, at least in the very short term, restrictive on growth. It's understandable to see yields dropping.
Yeah, and that's the chart we have here. This is the 2-year yield. Again, this was taken an hour ago. It's moved quite a bit since. It's broken through the support line. 2-year yields trading at 418 now. They're down 8 basis points on the day, and 10 years are down 11 basis points on the day. So we're seeing these moves having reverberations across all the markets. We've also had Putin come out at the weekend saying he's ready to talk about oil prices and energy with Trump. We've had quite a big move in oil last week.
Yeah, absolutely. So one of the things that, if you're a long-time listener of Macro Mondays, you'll have been hearing throughout the end of 2024, us almost bemoaning the fact that we've been in such a low volatility environment for futures and for crude in particular. Volatility is back, and I think it's here to stay as well, as Trump and his online presence remain significant. I think we're back in the days of any tweet being liable to see a $1, $2, maybe even $3 flat price move in a very short period of time. So the news that came out over the previous week or so, Trump at his Davos speech at the World Economic Forum said that he was going to call on OPEC to reduce prices of crude even further. I sort of left a few people scratching their heads as he was seemingly almost reneging on the Saudi commitment of $600 billion to the US economy. He was asking them now for a $1 trillion investment in the US economy, and for them plus OPEC to reduce oil prices. So it sounds as though Trump is going to be asking a lot of the US-Saudi relations going forward. So that was met with a sell-off in flat price. And he had also, of course, mentioned that Putin was going to be, ending the war in Ukraine was going to be top priority. Lower crude prices would enable him to end the war in Ukraine. And it sounds as though Putin is, ready to at least consider the idea of ending the war in Ukraine, as it sounds as though, Trump is going to be hell-bent on making this a priority for his government.
And he also wants to drill, baby, drill.
Yeah.
And if you look at the chart here, we have Brent. You can see how it rallied so aggressively just before the inauguration, all the buying in preparation or concerns ahead of tariffs. Well, now tariffs have been less likely, certainly for across these products, and also this sort of
I
supply talk.
Absolutely. If you are looking at this from a game theory scenario, I think basically the conclusion has to be that flat price is too high right now. He can, put a bit of a squeeze on Saudi, etc., by increasing supply. But particularly if you look at the product side, the number of commitments that the US had made to sort of environmental regulations and net zero contributions, they will likely fall by the wayside to some degree. So you're going to be seeing more refinery output. So even on lower margins, refineries are going to be incentivized to produce. And with crude falling even further, you might see those margins actually bounce back a bit. So I think from a crude perspective, things seem a bit, definitely seemed a bit expensive. And so the fall has been explained somewhat. And the question now becomes, are the tariffs going to actually come into effect? He was mentioning with Canada that he was going to ban all US imports of Canadian crude and replace it with US crude. Well, that probably won't work because they have different slates. They are used in different ways. It definitely seems as though he's hell-bent on imposing some tariffs with their northern borders.
And what we've seen with the last couple of weeks, Trump's inauguration as well, the dollar index has finally turned lower. It rallied 9% since October. Lots of pain there for emerging markets and commodity buyers. You can see from the chart, it's clearly turned, it's broken the support line, and the dollar's clearly in a short and intermediate term downtrend. What's important about that as well is actually last week, speculators had their longest position in the dollar since 2019. So when we get these crowded trades and it turns against the positioning, you see people moving for the exit very quickly.
Yeah, I think with the dollar as well, you can look to the US economy. Yet again, we can mention DeepSeek as an explanation, but I think it's also worth noting that Trump is going to be very keen to cut interest rates. He mentioned it yet again as one of his sort of goals for his campaign at the Davos speech. So you're not going to be seeing sort of hot money flows coming in to support that. In fact, quite the opposite. And when it's a crowded trade, perhaps people can take some pain on news like lowering interest rates, etc.
Yep, of course he wants to lower interest rates, but it's not his choice. The Federal Reserve, independent body led by Jerome Powell.
Absolutely.
What we're seeing as well in the US, signs of some economic risks emerging. Credit spreads are starting to rise. Bankruptcy index is edging higher. US trucking activity fell sharply in December as well, has an obvious impact down the supply chain. Bankruptcies are a 14-year high, and 10.75% of people are making just the minimum payment on their credit cards. This is the highest in the 12-year history of the survey. That's even with credit card interest rates above 24%. That's also a record high. The US leading economic indicators are also falling. These are down 15.5% from the highs. They're down the most since the financial crisis. Typically, we would be in a recession. The US would be in a recession at these levels. But it's important to say that it is different this time because the leading economic indicators is skewed towards the manufacturing sector. We know that's been in contraction for 2 years, but services and employment remain strong for now. There's also renewed confidence with Trump coming in. Again, that's going to be undermined with the DeepSeek news over the weekend.
But yeah, if you were to look at manufacturing as well, I think the middle American that Trump tried to appeal to so much in his presidential campaign, a lot of those people will have been formerly employed in manufacturing jobs. And I think perhaps by 2029, as Trump presidency comes to an end, there will have definitely been efforts made to bolster US manufacturing as well. So you might see services continue to be supported, and if they can, buff that up a bit with the slightly less significant manufacturing industries growing again, then it could be beneficial for the US economy.
I think what this data shows as well is the Fed won't hike again. The OIS is pricing right now, it's pricing 49 basis points of cuts this year. But some people in the market have been saying that the Fed may need to hike one more time with inflation ticking higher. But we'll see in a minute a slide that highlights inflation's likely to come lower. But the Fed's not going to hike with signs of weakness in the economy. And actually the OIS was pricing just one cut by year end last week. So we've had a significant move in just 1 week with yields moving lower. The S&P made an all-time high last week. It is going to break aggressively lower today. An important point to note here, again, this chart highlights the move in the S&P. The red line highlights moves intraday. If you were to buy on the open and close your position on market close, you'd have barely made money going back to 1993. Whereas you've bought on the close, held it overnight, and then sold on the open, you would have had huge outsized returns. Of course, that's a bad trade to have on today.
Yes.
Of course, we're going to open significantly lower, but it just shows a key dynamic of the market, that the market's moves are typically overnight. And another interesting piece of data out of the S&P, stock trading now has moved on to the dark pools. So dark pools consume over 50% of all equity trades. Now they are off the exchanges. On to CPI. Inflation, CPI in the US has been ticking higher, but you can see here how highly correlated it is to the new tenant rent index, which has declined sharply in Q4. Again, rent has been a significant part of CPI. It's been a sticky part of CPI. You can see that is now moving aggressively lower. One reason why I think inflation isn't going to tick higher from here. Another reason why I think we won't see a hike from the Fed. The next move will definitely be a cut.
Yeah, absolutely. I think, we'll come to talk about housing prices for purchasing, but definitely in rent as well. Seems as though there's more friction than there previously had been, and you're having to incentivize people with even lower prices in order to get them to move.
Some news out of China at the weekend, as well as DeepSeek. Interestingly, while US tech stocks are getting crushed, China tech was up 3% overnight. Obviously good news for Chinese tech. But we had the Purchasing Managers Index out of China, and we see some weakness there. Deflation, China manufacturing PMI back in contraction, 49.1, estimated to come in at 50.1. Services coming in at 50.2, last at 52.2. So China activity unexpectedly slowing.
Yeah, I mean, I think the Chinese economy right now is in, at a bit of a crossroads. There's been a huge amount of government intervention over the previous few months as the Chinese government has looked to bazooka these stimulus packages, etc. What I would say though is that beyond the DeepSeek advances, etc., we're going to be seeing manufacturing continue to decline, perhaps as it shifts away, and I do wonder whether we're going to be seeing that rescaling of the Chinese economy going more towards services and consumption, and this move away from manufacturing continue.
We just had a question come in actually while we've been on air. Question is, how opportune of a moment is this for the market to experience a pullback from its unsustainable run over the last 2 years? Is this a short pullback, 10-year 2, or a long-term top? I think we're talking about equities here. I would say actually this looks significant game changer for the whole tech valuations. If Nvidia is going to open up, or currently trading down 14%, then I think this has it's not going to be a short-term move. I think this has some definite some long-term implications. We've been saying for a while now how tech stocks and stocks are historically expensive. So I think this has a big concern.
Agreed. And yeah, I think the individual stocks probably were expensive. But, you know, one of the comparisons that I think could be drawn is if you look at pharmaceutical equity prices, a lot of the times you see a huge amount of volatility in these until a new patent comes in or a new piece of research, either proving or disproving a patent comes in. This could be the sort of volatility that we get into with AI as new companies look to establish themselves at the helm, et cetera, et cetera. They have a revolutionary outlook on things. If it is proven to fundamentally undermine the sort of emerging status quo, that can be really, really significant. So I don't think that this will just be, you know, a blip on the radar. I think this could be truly significant for Nvidia, et cetera. The one thing I would caveat that by saying is that I'm sure that this US, you know, Trump's presidency is going to be hell-bent on making sure that AI finds a home in the US and the US is at the helm of that. So even if DeepSeek perhaps, you know, enjoys some benefits for, you know, the next few years and is a significant player on the world scene, I think that the US is going to fight, you know, hell for leather to make sure that they spend and they are at least equivalent to that.
I think one thing that's different with this as well is it looks like consumers are going to get hurt with this sell-off. I mean, when was the last time consumers were hurt? I guess it would be with Bitcoin in the sell-off into 2020, when it sold off nearly 80% from 20,000 down to 4,000. We've had, with tech stocks so high, that's helped consumer confidence, it's helped spending, and it could have a serious dent on consumer confidence. Also, while we're talking about China, one sign of positivity in the Chinese economy is their car production is now dominating world production. Crippling, we've discussed before, crippling the German car producers. So in 1998, China accounted for 1.4% of global car production. 25 years later, 2023, accounted for 38.4%. And it's growing every day.
Yeah, that number's only going to rise. They are very much, you know, at the helm of the EV revolution, aren't they?
Yeah, BYD is becoming a dominant car company in Europe, let alone the rest of the world. On to US, home sales collapsing. Mortgage applications are the lowest since 1995. They fell 3.7% last week, their fourth consecutive weekly decline. Mortgage demand index, the third lowest level in nearly 30 years. And the index has fallen 63% in the last 4 years. Meanwhile, home inventory is surging. New single-family homes for sale in the US hit the highest levels in 50 years. So there we have the mortgage applications index down 63% in 4 years. Single-family homes for sale, highest levels in 50 years. That can only play out one way.
Absolutely. You know, it's going to have a negative price effect, and there are a number of reasons for this, not all of which, you know, are going to need to be said. Disposable income not being there for a lot of middle Americans, etc. But I think it's very topical to bring up the insurance premiums that people are being forced to pay on houses at the moment, particularly if you look, you know, we had a pretty significant hurricane season in the Gulf Coast earlier this year, but LA wildfires, they've been all over the news. The risk of wildfires significantly increases the insurance premiums that people have to pay, not just in California, but across a lot of the sort of southern and west US, which is quite dry. This, you know, even if this doesn't directly lead to the mortgage repayments, this is another significant expenditure on housing that people have to cover when they're purchasing. So it disincentivizes home purchases.
Yep. Another interesting dynamic worth discussing here is we've talked about equity markets. They're falling hard today. If you want to close your equity position, you can go online and close it. You can sell. If you want to sell a property, it takes months to play out. So I always think the property market, it's like an oil tanker, or
Yeah, it's slow.
It's slow. Oil tanker turning, it just takes a long time. Whereas what we're seeing in the other markets today, they're going and they're moving instantly. We can likely expect weaker US data going forward. Financial conditions have tightened. You can see here a good chart overlaying higher yields and the higher dollar. That is the blue line. It's US bond yields and US dollar index, Z score, and the brown line is the US economic surprise index. And you can see with financial conditionings tightening, that typically leads the economic data by 2 months. So we'd expect off the back of that to see some weaker data going forward. Also last week, we had a 25 basis point hike from the Bank of Japan. While other central banks are cutting rates, they hiked 25 to 50 basis points. And with that, the chart here, it's a favorite chart of mine, overlay of dollar yen, the white line with the orange line is the 2-year interest rate differentials. That's 2-year US bond yields minus 2-year Japanese bond yields. And you can see how the main driver of the currency here, G10 currencies, is interest rate differentials. Well, these moves suggest with the yen curve going higher, US yields, especially overnight, coming lower, we'd expect dollar yen lower. And in fact, we'd expect the yen crosses to be lower across the board. If we move on to the next chart, this is a classic risk off trade when people are unwinding their asset positions. You typically see, of course, equities fall, interest rate differentials fall, and Aussie yen is typically shows weakness here. You can see as we came in, Aussie yen was sitting right on support here, right on this long-term support line. And I'd expect to see more yen strength as yields. I expect yields will continue lower and we'll see ongoing weakness in equities. I think this is going to turn into a trend.
Yeah.
More weakness in Germany. Germany cuts 2025 GDP growth forecasts to 0.3%. from 1.1%. That's a big move. And 2026 GDP growth forecasts from 1.6 to below 1%. So Germany, Europe seems absolutely stuck.
Yeah, I think even anecdotally on these revised forecasts, some of the conversations on the trade floor have been even more bearish, the German economy, than these headline figures. It doesn't seem good. You know, we mentioned car manufacturing already. That used to be really significant German economy factor. Seems as though not only are they losing ground to China, but they're paying relatively high power prices, etc. Manufacturing is falling in a Western economy that was very dependent upon its manufacturing. It seemed for the longest time to be almost the odd one out in that sense, if you were to compare it to the UK and the US, etc. So yeah, it's not looking good, and obviously they have their snap election coming up, which leads to even more economic and political uncertainty.
Yep, and we have the ECB this week. The market's OAS overnight index swap is fully pricing in 25 basis point cut. In fact, including that, the market's expecting 93 basis points of cuts this year. Maybe they're going to have to go even more aggressively. And on to France, weak data there. PMIs have come out weaker. You can see from the chart, French composite PMIs for employment moving sharply lower. Last at these levels during COVID, and also announced they're planning more spending cuts and tax hikes in 2025. In fact, a bizarre statistic, 10% of corporate bonds in France now have a lower yield than the French government. Onto the UK, US budget deficit came in at 17.8 billion in December, estimated to come in at 14.2 billion. That's bad news. And employment rate, although that stayed at 4.4%, private sector payrolls fell again in December. This has been down negative for 10 of the last 12 months. Single month unemployment as well was the second highest since COVID. And you can see here, UK employees have shed 79,000 workers since the budget. It's a really sharp handbrake, that budget.
Yeah, I think the economic situation in the UK is very undesirable at the moment, and this is a fantastic illustration of it. Not only are people feeling the squeeze, but the budget deficit is just spiraling, isn't it?
So a trade I like on the back of that, shorting sterling yen. So you're selling sterling, buying the yen. Copper, it's had a volatile a couple of weeks. Copper prices surged in the new year. They've hit resistance. They're selling off quite hard. You can see here we have converging trend lines. It's bouncing between those two trend lines. It's not got any direction at the moment, but we're going to see a breakout fairly soon. And on to Bitcoin. Huge volatility today. It's trading under 100,000. You can see the key risk, key support line is still at 91,370. But Bitcoin has been, and crypto have been affected by these DeepSeek news. I mentioned Solana of 10%. Risk assets certainly getting hit hard.
Yeah, I think one of the contributing factors in this as well, obviously, I think a lot of people will have a basket of investments. If you're looking at your average retail consumer, they might well, if they're a Bitcoin owner, they are likely to have some Nvidia as well, et cetera, et cetera. So not only will you see the natural price action in things like Bitcoin off the news of like this, which perhaps suggests that US focused hegemony in AI is undermined, et cetera, but also you're going to be seeing people taking pain and perhaps stopped out of their Nvidia positions, and consequently more risk off when it comes to Bitcoin. So I think that will be a contributing factor as to why we're seeing such a sharp fall in Bitcoin here.
Yep, I was reading earlier, $2 trillion have been wiped off AI stocks already, and that's before the market's even open today.
Yeah.
Gold targeting new all-time highs again. Gold has actually sold off marginally today, but you'd see gold to be a beneficiary in times of panic. Gold,
safe haven.
Yep, safe haven, flight to safety. Target 2,790. I think it's just a matter of time before that breaks. Central bank overnight index swap pricing. What's the market expecting from the central banks? We have a Fed meeting this week. The markets are not expecting a move, but they are expecting 2 cuts over the next 12 months. Again, a week ago, market was just expecting 1 cut. So it's turning, yields are going lower. The market's getting rapidly more pessimistic again. ECB, 25 points expected on Thursday. And the other one to note there, Bank of Japan, market's still looking for another 2 hikes this year. And final chart of the week here, the Sensex. Here you can see long-term trend has been broken. And we have the Indian rupee at all-time lows as well. Actually, the peak of this was the beginning of October. So this has been a downtrend for 3 months.
Yeah.
Again, a crowded trade. And the news over the weekend is just going to add more weight to the downside here.
Yeah, obviously, as you say, it had been a fantastic performer up until recently, but momentum has really died out, and you might see, it's reached that trend line and might dip far below now off the back of this news. So it could be a sell here.
Yeah. And all these charts I'm bringing up, the asset prices, they're going from bottom left to top right, long-term trends, and now these trend lines are being broken. So there's definitely a rethink going on here in the market to a risk. So what do we have out this week data-wise? Pretty quiet week. Monday is new home sales. Tuesday in the US, durable goods and consumer confidence. Wednesday, Federal Reserve meeting. Again, no move expected. Thursday, ECB, 25 points. Probably the key data this week is Friday's core PCE inflation and employment cost index. But I actually think we're going to see a lot of volatility. It's not about the data this week. It's about market positioning.
I think one thing that we will have to consider as well, not only in oil and oil product markets, but across a lot of trading worldwide, is that it's Chinese New Year. And so it will be very interesting to see how liquidity is, etc. So you might be seeing some even bigger moves on relatively lackluster liquidity.
Interesting point. And big moves, of course, on Donald Trump tweeting.
Absolutely.
So we're going to have a volatile week ahead. Thank you for listening in and have a great week. Thank you.
Thank you very much.